Moneysense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Moneysense. Your hosts this morning are Christophe Barnett, myself Simon Caudry and Neville Hicks. Today's show is dedicated to discussing property investing. A large number of people consider the property market to be a surefire winner, and sometimes that only ever goes up, and sometimes something that only ever goes up in value. Variations on this theme are something like land is in limited supply, populations keep growing, and therefore property is an essential investment tool. Are either of these statements even close to being true? If you look at Japan, it suggests not. Population in Japan, one of the richest countries in the world, is actually declining. If you look at land being in limited supply, there's an argument to say that in cities, people actually prefer to live in closer densities. And so actually, the limited supply of land argument doesn't seem to hold true either. So what about the Cayman Islands? That's the focus of today's show, trying to discuss whether property in the Cayman Islands is a good investment, and if so, where to invest. And then given that knowledge, what are the actual costs of investing, and what should people who are thinking about buying property think about in terms of the economics and the maths of it? So let me start by introducing the guests. We have Kathy Williams from Williams Squared. Good morning to you, Kathy.
Good morning, Simon.
And thank you for joining us. And then we also have Dallas Needham from First Caribbean Bank. Thank you, Dallas, for joining us.
Good morning, Simon. Thanks.
So let me start off, if I may, Kathy, by posing you a question. So, Kathy, you're a realtor. You're a partner in a real estate company here on Ireland. And the most simple question I guess I can ask is, what is the Cayman property market today? Is it a good time to invest? Give me some background on the property market here in Cayman.
The property market in Cayman right now is absolutely on fire. It's most definitely a supply and demand issue. We have huge demand and not enough supply. In the many years that I've been in real estate, I've never seen a property market quite like it. Land is disappearing along the 7 Mile Beach corridor, canal front property from Canal Point, Crystal Harbour, Yacht Club. And I'm sure that my colleagues here will agree with me. There's actually none left. There's nothing for sale in Yacht Club. There's nothing for sale in Crystal Harbour. There's nothing for sale in Canal Point. There's a decentralisation happening now. Grand Harbour, there are 2 lots canal front available left. That's it. It's all gone. People are then moving out towards the sailing club. I think Harry Lally has a fantastic development down there, which is a canal front development. They're also going rapidly. So there's this huge, I suppose we call it a scramble for Africa, or in Ireland we call it the Celtic Tiger, where there was this huge renewed confidence in the real estate market. And here in Cayman we've seen an incredible increase in purchases right across the board. 7 Mile Beach condos, commercial buildings, high-end residential homes, middle market residential homes. It's I've never experienced a market where we have 3 or 4 people bidding on the same property. That's a property that arrived in the market on a Monday morning and has 3 offers on it by Monday afternoon.
And who are you seeing those buyers representing? Are they local persons, or are they overseas buyers and foreign investors? I
would say right now we have about 20% of foreign investment and the rest is the local market. There seems to be a huge renewed confidence. I have to hand it to Mr. Dart. Once he presented his presentation, I think he did about 8 or 10 presentations about the revival or the next 5-10-year plan of the Dart project on the 7 Mile Beach corridor. When Jackie Doak finished her speech, there was a complete silence in that cinema. And I think everyone ran out of the cinema and thought, I need to buy right now. This is the most exciting time to purchase real estate in the Cayman Islands. It's right now.
So why is that? I mean, that presentation was about the re-energisation, I suppose, in some respects, or the change of the 7 Mile Beach area, about building a hotel or a couple of hotels. Why does building a couple of hotels make a fundamental difference to the property market in Cayman?
It's not even just a couple of hotels, Simon. It's this incredible opus that they're creating, which is everything from improving our quality of life, our standard of living. They're not just about building bricks and mortar. They're about creating an environment that will attract foreign investors, that will create jobs, that will beautify that 7 Mile Beach corridor. And also, it's not just the Dart project. It's Cayman Enterprise City. It's the Shetty Hospital. It's this combustion of incredible, intelligent product that is presenting Cayman as this intelligent, sophisticated market to either live here, raise your children here, or invest here, retire here, your first home, your last home. It's a really exciting time.
Kathy, it seems that certainly from the perspective of the 7 Mile Beach corridor and even out to Grand Harbor, that things have picked up significantly. What are you seeing kind of further east as you kind of move into Boddentown, or not
Savannah.
even Savannah, Boddentown, East End, North Side? Are we seeing kind of a general pickup across the board? Or is it just specific to kind of the 7 Mile Beach corridor and the canal front lots?
Well, as Simon mentioned earlier, you have, and he related it to other markets in different countries like Japan, or let's just say Dublin, my country of origin. It's called a decentralization process. So when land or property becomes either too expensive or not available in the city, as it were. So let's talk about Georgetown, South Sound, 7 Mile Beach corridor. We will gradually see, or probably progressively see, a decentralization where folks will now start, and we can see it already. It's eking out. Anything from Patrick's Island out through Prospect. We're seeing more and more properties for sale there. We're seeing more and more people buying there. And then eventually it will move out to Boddentown, and then eventually it will move out further to Frank Sound. So that's just a natural progression.
I guess there will be some implications, or presumably positive implications, if we get further hotel development out in East End or North Side. Is that a likely scenario, to your best of your knowledge? Is that something that could be a catalyst for those areas of this island to help that property market out there? Tell me what your thoughts are there.
The interesting thing is, it's not the metropolis. This beautiful country is 28 miles long by 9 miles wide. We are, I used to say 12 months ago, we're poised for explosive growth. Well, actually, I'm going to resound that and say, or re-say that and say, we're actually in the middle of explosive growth. It's an exciting time, and I do believe the outer territories will be feeling the knock-on effect of this incredible combustion in the real estate market very, very soon.
Okay, so take the sort of typical Caymanian person, or a person who perhaps can't afford a 7 Mile Beach condo, and it's probably fair to say that those prices of those condos have gone up in value. There's been a lot of demand. What about the typical 3-person or 4-person house or apartment? Have we seen substantial changes in those prices? Because the anecdotal evidence I hear is that there's been a lot of transaction volume recently, but that hasn't necessarily filtered down into the prices that are being received by those people who don't own on the 7 Mile Beach corridor, don't own on canal, don't own on waterfront. So what's the context there that you can give us?
The interesting point is, and I probably have spoken quite a lot about the 7 Mile Beach corridor and condos and high-end residential and canal front properties. Let me talk about residential homes. I listed a home 6 years ago when the market was completely depressed. And I would like to think that I'm a relatively decent realtor, but it took me 3 years to sell that home. I subsequently sold it to a young couple with a young family. They decided to sell this year, so this is 3 years later. And I listed on a Monday morning, and I had 3 offers by lunchtime that Monday. Now, I need to tell you about the offers. Each offer was better than the asking price. So the market is dictating an increase in the price of homes. It's historically, we waited until a valuer, respectfully, valuers would come in and they would look at comparables and sales history and say, okay, this property is now worth 400,000. But what I'm seeing, and I do believe is going to continue this way, I'm now seeing the market dictating what they're willing to pay for a property. So the market is offering above and beyond even the list price of that property. And I'm seeing bidding wars. I've never seen this before.
Well, that's going to be. We're going to come and talk with Dallas, who's representing one of the banks on Island. We're going to talk with him about the implications for people who want to borrow money with that sort of scenario, because of course that changes the dynamics of what you're actually going to be able to get from a bank if it's over and above what valuers will perhaps offer. I mean, how does a bank respond in that sort of circumstance if you're listed on the market at, say, 500,000, the valuer says, well, somewhere between 400 and 500, and you have to pay 520, 540, 550 in order to be able to purchase it. What happens there then, Dallas?
The bank looks at it from the point of view of they take lesser of the two. So it's the purchase price or the appraisal value. So if they do purchase above what the appraisal value is, the client would need a larger down payment in order to close the transaction.
So the implication for someone who does that is that they're going to need more of their own cash to invest in that property.
Yep.
And that I think, one of the things I think we always need to bear in mind, it's great to have an island where the property prices are going up in value. I mean, that's good for everybody. But we need to be careful about the risks that property gets too expensive and becomes bubble-like. And Christoph and I, before the show, were talking about the implications of property price bubbles. There are many markets around the world, in the US, in Ireland, Kathy, where your home country is, Canada as well, has been seeing some circumstances like this, where properties have gone up in value for many, many years, and then can decline by 30 or 40% in a heartbeat.
Simon, you are correct. My country experienced that. In fact, every major capital city across the world did, but we didn't. And back to what Nathan has just said, Cayman has Dallas, Nathan has just said. He basically said exactly where Cayman stands as far as lending. Cayman has historically been very conservative. There was no subprime mortgage reality here in Cayman. There has always been a consistent and steady increase in property prices, and the banks have always been conservative. So I doubt very much whether the fantastic growth of the real estate market will result in a peak and throat like other countries. The banks will stabilise it. They'll keep it consistent.
Fair enough. Well, let me interrupt that question there, because you say the banks will stabilise it, but there's been a little bit of press recently, bad press some might say, about some of the actions the banking industry has done. Now, I'm not saying the banks are in the wrong for doing this at all, but what's been happening is that there have been an increasing number of foreclosures on properties, and they've been reported in the press. So the argument that that lending amounts weren't excessive in the past could be argued, well, in some respects, there were some problems in Cayman in the past because some people have been foreclosed out of their houses. Now, it's not a question specifically for you, Dallas, but it's rather just to throw that into context. There have been some issues in Cayman.
Simon, I totally agree, but we have to also understand that for 5-6 years, as the global markets declined and we were in a global depression, that certainly did have a knock-on effect here in Cayman. And it may have resulted in unemployment, it may have resulted in non-repayments of loans, and that obviously, included mortgages as well. So I do believe that we're seeing the remnants of the knock-on effect of a global recession that was only yesterday.
Fair enough. Okay, thank you. Look, what I want to do now is going to take a brief break. We're going to come back after the break, and Dallas, I'm going to throw some questions at you, specifically for people who have listened to what Kathy's said. And she's promoted the property market here in Cayman. She said there are many opportunities, given some very cogent reasons why. I want to address, well, if someone says, okay, I want to invest in the property market, what do they actually have to do? What are the mechanics? What are the costs? Those sort of things. So we're going to take a break now and come back and ask you those questions. Welcome back. For those just joining us, we are talking this morning with Kathy Williams and with Dallas Needham, talking about the property market and investing in the property market in Cayman. The purpose of the show, the first part of the show, we discussed the market in Cayman, and Kathy mentioned that there had been a huge amount of positive momentum in the property market. We'd seen a lot of transaction volume. Kathy, you discussed about the opportunities in Cayman here for property investing, and I think it's fair to say you were generally positive and optimistic about the marketplace. So what we want to talk about right now is discussing for those people who have shared that view or are persuaded by that viewpoint and say, well, I want to invest in property. What do I do? What are the implications? What's it going to cost me? How do I go about getting a loan? What are banks going to ask for? Because it's no point being a willing participant if you actually can't get the financing. Neville, do you want to start off the questioning on that?
Yeah, I think in any sort of investing standpoint, you need to look at all the factors. And as much as the market might be going up, I think everyone needs to take it in their own context and understand what their own kind of capabilities are or what their own investment needs are. And I guess just over to you, Dallas, what from the bank's perspective in lending, what do they typically look at from an individual who's coming in from amount of cash they have or net income they generate as far as the amount of money they're willing to lend towards a mortgage or even, say, an investment property?
Thanks, Neville. The bank looks at a couple of different factors. For permanent residents, traditionally we finance up to 90%, temporary residents up to 80% of the purchase price. And if we're looking at, those are owner-occupied. If we're looking at investment property, the benchmark's usually around 65% financing. One of the things we see a lot of, which a lot of people don't, we recommend clients build a budget look at the numbers, outside the down payment, there are a lot more costs. There's stamp duty, for instance. There's stamp duty on the purchase. There's also stamp duty on the loan amount. So it's 7.5% stamp duty on the purchase price, but also 1.5% on the loan. In addition to that, you have the bank's commitment fees, and then you have legal fees. So a benchmark we use for all our clients is say 10% of the purchase price is going to be sundry extra cost outside of your down payment that you need to factor in and build into a budget to see if that's something you can afford. The bank also looks at debt servicing. Can a client service the debt they're looking to obtain? Traditional benchmarks there are about 45% of an individual's net monthly income. What I mean by net monthly income is individual takes their gross income, minuses their deductions like pension, medical, anything that comes off their paycheck. That'll give you your net, and 45% of that is what the bank traditionally lends up to. Now, also included in that number would be if there's any other car loans or credit card debt, the bank factors that into monthly payments, and that you can subtract off of that number and arrive at a quick number of what you could afford monthly.
Let me ask a question on that. You mentioned, I want to take an example of someone with a $500,000 house. That's go back to the earlier conversation with Kathy. Someone's successfully made a bid. It's been accepted on a $500,000 house. What you're saying is that they need to be prepared to spend $550,000 to buy that $500,000 house with the 10%.
Actually, yeah, it'd be the down payment of 10%. Let's say it's a permanent resident, so 10% down plus another 10% in closing cost.
So they themselves
They
need
need
to be they need to be spending $100,000 cash themselves.
Yes.
So the total cost of that property is going to be $550,000, of which they are needing to contribute $100,000 of it.
Yes.
So they'll come to you or to any other bank for a loan of about $450,000 in that scenario.
Yep. We can also look at, depending on the individuals, the banks sometimes look on if they can debt service. Sometimes we can help out on the side, usually not for the down payment, usually on stamp duty costs. We could look at doing a side loan. It's financed over a much shorter term, though.
Okay, so that means they wouldn't necessarily have to put that $50,000 cash, which goes to legal fees, stamp duty, straight away in cash out of the door. They could potentially borrow that for a shorter period of time.
Potentially you can, yes.
Okay, fair enough. And then, so the debt service that you talk about, just refresh my memory on that then. So someone is earning, I don't know, let's say someone's earning $60,000. You're deducting pension, you're deducting medical from that. That's perhaps $10,000 or $15,000 a year, so they're down to about $45,000. You will lend as a multiple of that $45,000, is what you're saying?
Yeah, usually, like I said, the baseline's 45%. It's better to come back to the monthly side because it's all monthly payments in your mortgage. So you take that number.
Let's say that's $4,000 a month.
So $4,000 a month, 45% of that. That's traditionally what the bank will end up to. Now you got to minus out if you, let's just say it's $2,000. If there's a credit card or a car payment for $300 a month, you minus that out. Now you're down to $1,700, and that's how the bank gets to its total, what we call a total debt service ratio.
And that 45% includes principal and interest.
Yes.
Is that correct? Okay.
Yeah.
Okay, so there's a lot of maths that we're doing, and this is a radio show, so people are sort of, we can't put up the numbers on a board and make it easy. So I just want to try and sort of explain this so I can sort of sympathize with people and try and understand it. I've got my salary. I take away the cost that I can't get out of, the pension, the medical, my credit card bills, any other things like that. I then say, okay, once I get that number, the bank's going to probably willing to lend me perhaps up to around about 45% of that. So that's the amount I can afford on a monthly basis to pay towards my mortgage. That also has got to be, you've also got to consider the fact they're not going to lend 100% of the property. So those two things go together. So I've got that in my head. What happens now then? What's it going to cost me to borrow? So I'm going to come to you and say, okay, I've got this money. You said, fine. We've gone through this budget. All makes sense. What are the actual borrowing costs going to be? What are the rates of interest that people are likely to spend?
I'd say traditionally a benchmark to look at prime plus 1 on the island, so 4.25. Okay. There's some deviations among the banks. It all comes down to, again, property and individuals who are behind buying the property. But usually 4.25 is a good benchmark. Other costs associated are bank's commitment fees. On average, are anywhere from 0.5% to 1% of the mortgage amount. Okay,
so we have Christoph in the studio with us, who's furiously typing away on a calculator and doing the maths as we speak. And without passing the buck over to you, Christoph, have you got this fictitious $500,000 property? What does that actually equate to on a monthly basis for someone?
Well, first, I just want to say, Simon, that in today's technology age, it's very easy for anyone to just go online, look for a mortgage calculator, put in, after you've done your budget, like Dallas has mentioned, go ahead and look at the price of the property you're looking at, how many years you have to retirement, or maybe ask the bank how many years you'd be able to borrow. What is that usually, Dallas? Is it 20 years, 25 years?
For permanent residents, you can go up to 30. Temporary, you traditionally up to 20.
Okay, so let's say 20 years. So there are apps for your smartphone, or you can go online and search for a mortgage calculator that I have right here. So I've put in $500,000 for a house, 20 years, an interest rate of 4.25, which is a prime plus 1, and a 10% down payment. And it's saying that the monthly payment would be just under $2,800. So then if you look at your budget and say, okay, does 4 to 5% of that, of my net take-home pay cover that, then you're armed and you're almost ready to have that discussion with the banker even before you go in. And you can put in various scenarios. You say, well, maybe there's a different house. You can adjust that price. Maybe there's 25 years versus 20. The longer you go, it'll be lesser payment. But I would definitely suggest people be armed and ready with as much information, both on their own budget and then what the market looks like.
So what you're saying there is someone who buys this $500,000 property, they have to put approximately $100,000 of their own investment into it once all things considered, and then it's going to cost them about $2,800 a month in terms of repaying the mortgage and paying the interest on that mortgage.
Correct.
Okay. That leads on to the next logical question as a result of that. What happens when interest rates go up then? You're talking about, explain to me, are the loans that you're doing, are they flexible? What happens when interest rates change? Tell me about that.
Since I've been in the island shortly for a period of time, so under 2 years, all loans that I've done so far, everybody's looking for variable open, provides flexibility. Banks do offer some fixed rate. I've talked to a couple people in the bank, haven't done one or two in maybe the last 10 years. Rates are traditionally lower under the variable products. We do recommend clients that once we're looking at a budget, and we sit down with them also and say, okay, what happens if there's a little rate increase? If there's a rate increase, can you still afford it? Nice thing about the 45% buffer, it does give you some room. That's why we're not lending at 55% of the net income. So if rates do go up, traditionally most clients still have some disposable income that can afford the payment still. Because the bank will sit there and say, okay, we'll contact the client and let them know now rates have gone up, and here's what the new payment equals out to maintain the existing amortization you currently have.
Got you. Now, there's a huge amount of debate in the financial markets about next week's Federal Reserve policy meeting about whether they'll raise interest rates for the first time or whether they'll defer that until perhaps December. But the general consensus is interest rates in the US and interest rates in Cayman are based on interest rates in the US. Interest rates in the US are going up. So what does that mean for someone who borrows this amount of money? So let's just say by the end of 2016, the central bank has raised interest rates by a couple of percentage points. Someone who's thinking about buying a property now isn't going to be in the same situation because of the fact the interest rates are higher and because of the fact, generally speaking, they're getting variable rate interest products. They're going to actually not be able to afford the same amount that they were able to afford, and that goes back to the budgeting. And Christoph, what does that mean then for someone who's borrowed that money? They're currently expending $2,800 a month. Interest rates go up 2%. What are the implications for them?
So again, I would say do some scenario analysis, bring up the same mortgage calculator, put in various interest rates to see what your budget will look like under various scenarios. So we start at the $2,800. I've increased my interest rate by 1%. We've gone from $2,800 to just over $3,000. So that's $200 extra a month if interest rates go up 1%. And if they were to go up by 2%.
Are we going to double this?
Let's see what the damage is. So another $290. So we're up to just under $330. So $3,300. So $500 total increase from that 2% increase in the interest rate. And I think definitely a factor.
It's probably interested in your perspective on this, Kathy. It's probably important for people to bear that in mind when they're buying a house. Interest rates have been incredibly low for, goodness me, 5, 6, 7 years, it seems like. And that's enabled people to borrow money, provided banks have been willing to lend it, but it's enabled people to borrow money at very low levels of cost. Mm-hmm. If interest rates do go up and it costs people more to borrow money, that makes the purchase of a house more expensive. And so that logically would have some impact on the desirable, the affordability of housing, and therefore that might affect the demand for housing. And that's presumably possible, isn't it?
Sure. I mean, it's all down to making intelligent decisions. Thankfully, we have incredible retail banks who sit with their clients and guide their clients and, give them all the options and tell them all of the variables that could happen. In fact, when I just purchased a new house myself recently, and my banker sat down and said, here's the worst case scenario, and I think you can still afford it. So it's not that anyone is being misled. Certainly from a banking side of things or a financial side of things, they're being guided perfectly through the retail banks in this country. And I have to say they do an excellent job. By the time they come back to me, they know exactly how much they have to spend.
Fair enough. So I guess the last thing I want to focus on related to that is talking about the price and the cost of buying houses. Given that there's a forecast out there in the market that interest rates are going higher, and perhaps Neville, Christoph, the question for you, interest rates are going higher, should people actually be considering fixed rate mortgages? Should they be thinking the variable's still the way it should go? What's your perspective on that?
I certainly think it's a chat that you should be having with your bank as far as options go and to see what's available, because if rates do go up, it's certainly, like Christoph pointed out, it can certainly impact your monthly your monthly amount that you're paying on your mortgage. I think it's important too to note that I don't think it's necessarily the banks that are the enemy in this case. They're out there trying to kind of protect you from borrowing too much, and that's why they have these rules and guidelines. And I think like anything, it's important that you consider your own portfolio or your own income in conjunction with that to make sure you're not kind of over leveraging.
I completely agree. In fact, the banks are fantastic. And what I would do if somebody came to me to purchase a home, the first thing I do is send them to their banker. They need to understand exactly, as you see, the implications of the down payments, the stamp duty costs, the other
what they can afford,
costs,
right?
Exactly what they can afford. So when they do come out to look at property with me, at least they know that they are qualified to do so,
right,
and they're not overextending themselves.
Yeah, the banks, we love to have people come in and just run through them quickly and say, hey, here's the number we think you should look at.
Yeah.
And at least that gives them a baseline to go out and, like you said, look for property and know what they can afford.
Exactly.
Okay, well, I'm going to try and summarize this and not to use too many numbers, but thank you, Christoph, for doing that. I think what I'm hearing from the audience here today is, so guests here today, what I think what the audience is hearing is that the property market in Cayman is doing pretty damn well at the moment.
Absolutely.
Likely to continue doing pretty damn well.
Absolutely.
So that's the realtor's sales pitch for you there. But there are some potential hurdles on the horizon. We've got interest rates, which could cause people's ability to finance houses to go up and therefore to make their affordability a bit lower. And also people need to be conscious that property isn't just a one-way market. There have been examples in different countries of things going wrong, and therefore you need to be very cautious about how much you borrow so that you can afford to pay those borrowings when conditions in the economy do change. And that housing number that we talked about, if you're borrowing that $500,000 and interest rates go up a couple of percentage points, it's going to cost you $300, $350 extra a month if that sort of circumstance arises. So do think about property as an investment. It's a good way. As an investment professional, it's a good way to diversify your investments. It's something that isn't correlated to bonds, to equities. So it's a good potential investment, but also think about the implications, run some scenarios for when economic conditions do change. So with that, thank you, Kathy. Thank you, Dallas. And thank you, as always, Neville and Christoph. And we look forward to you joining us in 2 weeks' time for our next Moneysense show.
Moneysense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.